G'day folks, and welcome to an on-chain update for the 2nd of May. Now, what I wanted to talk about today is how I'm actually thinking about this dip. And this is going to be a little bit of a different session. So what we did yesterday was a bit more formal. I kind of do two different types of content. You probably saw more of this type in the Q&A the other day. What we did yesterday was a bit more formal, right? It's getting into the nuts and bolts. It's really trying to understand what's going on and, being a bit structured and saying, look, here's your risk vectors. Here's what I'm thinking about. What I want to do in this session is a little bit more personal. And the first thing I think with this, it can be useful for people to understand how I think about these markets. I use my own tools to make my own decisions. And the reason why I'm making this video is I bought a bunch of corn today following this dip. I don't know, 57,800 according to my block clock. And the reason I wanted to make this video is to kind of show you how I literally think about data myself. Now, this is not because, I think it's a good idea. This is just because, it might be useful for people to see how my own mental model actually works, how I use my own data to make my own personal decisions, because Bitcoin can be a bit of a lonely journey. Markets can be a lonely journey because they're volatile, they chop around. It's, most people just don't have the time to become expert traders. I'm not an expert trader myself. So just having someone else's thinking as a framework, it may be useful. So that was kind of the impetus for making this session. So overall, my general thesis with these markets is that volatility creates uncertainty. And particularly in moments like yesterday, where you get this really nasty sell-off and, we are below the short-term holder cost basis. So look, we have to be really open-eyed here and say, look, this could take some time to recover. But I've personally found that just grounding myself in some data and, making the best possible guess we can. And I think this last point here is actually really important. You'll see me echo this all the time. We just don't know, right? We don't know if the full market cycle top is in. We can certainly bound the problem and try and understand the mechanics of it and all those different things. But the truth is Mr. Market will do what Mr. Market does. So knowing that future is uncertain and the world could go in any number of directions, what I try and do is use probabilities and just look at how the market tends to behave around these levels. And then I make my own personal decisions accordingly. So again, please use the comment section. Let me know if you enjoy this kind of material. As I said, this is going to be a little bit more personal. I'm not trying to be correct per se. This is not about what the future holds. This is just more about how I personally use my own data to make my own decisions, because that may be useful as a framework for people moving forward. But very much just coming from this is how I look at it myself. So let's get stuck into it. Okay, so first things first, I finally managed to put myself in the top, so hopefully I don't block what's going on down the left-hand side. I keep telling myself to move the video, but it never quite happens. I wanted to start with the ETFs because this candle here is really the one thing that we really should just be quite conscious of. $776 million in outflows, and not just GBTC, they're just doing their stock stand 167 million, FBTC 191, right? And even IBIT. BlackRock had 37 million. So we are not talking about small money here. Now, these are just some of the elements that we need to just be really conscious of and pay attention to. This is probably going to take some time to digest. I'm not anticipating that. I mean, we could get a couple of days like this, right? It's Thursday at the moment. So at least in Australia. So Thursday could be another rough day with the ETFs in the US. So I don't know how this is going to play out. This is always going to be a bit of a variable. But even though we've got this pretty nasty outflow, Bitcoin has pulled back to the short-term holder cost basis. It's trading below it. And when I see something like that in what I personally believe is a bull market uptrend, I see more opportunity than I do panic and fear. My initial instinct is that, okay, there's always going to be a bunch of lettuce hands who are buying into these ETFs. You're never going to have everyone who's a diamond hand. We're going to go through these ups and downs just the same way we do with spot market. So I'm not anticipating any kind of fireworks to the upside soon. So even though this is the case, why on earth would I step in front of the train and actually, again, I'm not moving markets here, but why would I stack sats for myself, right? What was my framework for, despite this massive nasty candle, why did I still actually make that maneuver? Now, the first thing, I just want to go through drawdowns. Again, you'll hear me talk about this stuff all the time. If we're talking about probabilities, in my view, there's probably three, right? Big picture, not kind of trying to predict the future here. There's three major probabilities. One, this correction looks exactly like these in 2020 and like these in 2016, right? It's a dip and we we'll press on over the course of the next weeks to months, right? It'll take time for us to get there. We'll take time to find some kind of a bottom. It's not even the worst drawdown, 20.4%, right? We get 25s and 30s all the time. So the truth is it could go lower, but option one, which I personally believe is probably the more likely scenario, is that we just bounce and we carry on, right? And everybody goes, gee, what was all that panic about, right? The other one is that we get something like this 2019, we just chop around for months, right? And it's that boredom component. And we'll talk a little bit more about that. I don't know what the odds I'd give that. Maybe 30%, 40% is probably something where we chop around for a series of weeks to months. I don't think we've got a March 2020, but again, we'll let Mr. Market and Mr. Macro sort that side out. I'm not kind of factoring in some kind of black swan because by definition, you don't know. And then there's the other potential, which I don't know, I'll give it a 10% kind of gut feel, is that we've got some kind of 75%, 80% multi-year drawdown and, Peter Schiff's going to have an absolute field day. I'm not personally, okay. If that's a potential, then we'll take that one as it comes. But personally, I don't particularly see that being the case. I think we would find a floor well before that, right? So I'm not expecting to trade down at 20,000 again. That's not something that is really high on my agenda. Now, if we look at our drawdown profile, again, there's a lot of panic out there, and rightfully so, but it's been way worse. Now, the reason why I keep looking back at 2016 is this is a spot-driven regime. There's a lot of similarities. Just in the way that Bitcoin is trading, there's a lot of similarities between 2016. I like the analog to 2019 as well. So somewhere in the 2016, somewhere in the 2019, very spot-driven. This was all plus token Ponzi, so it kind of has the same net effect as GBTC consuming all these coins, albeit with stacks of derivative leverage in 2021. But in terms of an analog, I like the 2016 and the 2019 model the most. And I put a bit of weight in here for 2021 because we still have derivatives, but they're kind of the frameworks that I use to kind of ground ourselves. Okay, so in terms of, let's talk about those two potentials. Now, what I'm going to do is just put in a box over here. The bear market is here and it's all over and I'll see you at 75% down. I'm going to put that as let's not worry about that for now. Let's just assume that we're talking about the two other options, which is a 2019 market, which is, let's call it time pain, time and chop solidation. And the other one is that we actually find some kind of a floor and bounce, right? Whether now or at some point in the future. Now, if we look at the Mayer multiple, I like the Mayer multiple because it's really simple, 200-day moving average. Lots of people are going to use it. It's something that is going to be in everyone's mental model. The blue line here is Mayer multiple of 1, which means we intersect the 200-day moving average. Let's keep our rationale here of 2016 and 2020, 2019, particularly 2020, because we're actually in an uptrend at that point in time. And both of those are halving years. All right. So we don't actually come back and revisit the 200-day moving average in any point in 2016. In fact, the entire bull market, we just didn't until after we broke through the floor here. We did intersect it back here in September, which was a nice little washout. This was actually a really good case study for something that could have gone really nasty, but didn't. Probably a topic for another day. We didn't touch it again here in 2020 either, right? So we had a bit of chopping around in 2019, but 2020 in the uptrend, we didn't. And here we are in what, let's call it a very similar mechanic. We're trading somewhere between the 200-day moving average and a 50% premium to it, which is our orange line. Now, note that 2016, we poke our head above and we never quite get up to the new amplitude, and then we do, right? And then we start moving around at a higher amplitude. 2020, we didn't quite get to bounce around, but once we got through all-time high, we moved up into this higher amplitude, right? Now, what do I mean by amplitude? We're quite literally trading at a much larger deviation, a premium above the 200-day. The 200-day is struggling to catch up because there's so much demand and excitement and euphoria and all that stuff. Where we are at the moment, we're chopping around. We tried to get above. So we got this ETF hype, but what you've probably felt is that ETF hype, it's waned, right? It will come and go in waves. It's going to take a long time for all of these firms to do their due diligence and for people to come in and investment advisors to feel comfortable with it. It's going to take time. Then sometimes you need like 6, 12 months of trading history. So for the most part, we're only talking about early adopters of these ETFs. So as a result, we spend a lot of time in this range, 2020, 2016. It doesn't surprise us that we kind of poked our head up and are now trading back in this range. So does this feel abnormal for a bull market? No, it actually feels like a bull market, right? And in fact, not only that, it feels like the earlier phase of a bull market. Now, of course, if we keep trading lower, yeah, we'll start to look at that and change our opinion. But the 200-day moving average is, let's say, 50,000 or 49.3, right? I mean, that in terms of a technical level, that would be a round psychological number. It would take us back down to when the ETFs launched. Do I really think that, we opened the year at 42? Do I really think that we're going to erase the entire ETF inflow? Probably not. Probably not. I think that would be a very low probability scenario. So, maybe we come down and touch 50, but maybe we come down and touch some kind of premium, 10% above that, right? 55. Or sorry, yeah, 55, somewhere in that kind of realm. We're not too far from that. So, by and large, I feel like a lot of the damage could be done. That's my initial kind of gut feel and thinking. If we look at it on the Z-Score, which is just bringing it into the world of statistics, just waiting for this thing to load. It's doing some thinking. Here we go. In terms of a statistical level, so in terms of how much the Mayer multiple is oscillating around, on a statistical basis, we're fully reset. So we're literally at the long-term mean. So as I mentioned, we traded a slight premium to the 200-day during bulls, but on a statistical basis, that slight premium is the average, right? That's the normal. So we're not at some kind of massive premium on a statistical basis to the 200-day. This feels like a nice cool down, right? Yes, we trade below it during bulls. Yes, we trade it below it during bulls. But, for me personally, again, I'm not interested in picking the bottom, the Pico bottom. For me personally, I'm about stacking corn at opportune times. 73K, probably not so opportune. 57K, 58K, well, a bit more opportune, right? That to me feels like we've had a bit of a discount and we've traded down to a lower level that I feel a bit more comfortable with, right? It doesn't feel like we're trading at some kind of extreme premium. We chop around plus or minus 10, 20%. It doesn't phase me too much personally. But it's definitely not at a 50% premium, right? So that's my initial way of thinking about it. If we look at it from a probability standpoint, now you've seen these before. We covered this in one of our previous reports. Let me do a very quick snapshot for those who may have missed it. What we're looking at here is the histogram, all of the historical observations of the Mayer multiple. So essentially what metric value has it closed at on any day? And you can actually see the distribution of where these things are. Now, the orange line is then the cumulative distribution function onto the right-hand axis. In other words, it will sum all of those observations and say, if the percentage here is 80%, that means that 80% of all observations are smaller than that value, 20% are higher than that value. Now, where we currently are, 57%, right, of a Mayer multiple of 1.15, so a 15% premium to the 200-day, 57% of observations are lower, which means that 43% of observations are higher. Now, to me personally, we're in the middle of it. There's no gravity really in either direction. This tells me we're pretty much where the market likes to be. If you're at an extremely high value, there's not many instances higher than that, so the gravity is to the downside. If you're on the low side, it means the gravity is actually back to the upside because there's not many observations lower than that. When you're in the middle, you're quite literally average. You're in the middle. You're where we spend the most amount of time. Now, let me just jump back to the Mayer multiple. When I say we spend the most amount of time, we spend the most amount of time. We're here. We're kind of in the spot where you expect the market to be. There's nothing abnormal. In fact, almost definitionally, this is the most normal that we've been in some time. So again, that to me feels like a cooling down, but it also means that time pain, that duration, right? I'm willing to wait. I've been waiting for however long it is. Bitcoin makes you wait. To me, this is just part of an average day in the world of Bitcoin. So we're not at one of these extreme levels where it needs the gravity is to the downside. We're just somewhere where I expect chop and time pain. And time pain is something I'm willing to weather, right? I'm long-term hodler. Now, again, I promise not to bring this chart up all the time, but I really think it is a powerful one. We got to just keep in mind that we do have 3.3 million Bitcoin on the short-term holder side, which are in loss. Now, I won't spend too long on this, but we're also at the short-term holder cost basis. Now, there's a few other instances like this. Let's, again, use 2016 and 2020 as our analogs. Very frequently, we're not quite at the one standard deviation level, but we are above the mean, so looking for orange dots. Coming back and testing and trading below the short-term holder cost basis is not only common, it's kind of expected. It's I mean, in many ways, where else would you think it would be a good opportunity to take a dip? To me personally, the fact that we're trading just slightly below the short-term holder cost basis is quite literally why I pay attention to the short-term holder cost basis in a bull. It tells me one of two things. And when we trade below it, it's usually a point when you're reaching some kind of a local minima, right? Historically speaking, yes, it feels pretty scary at the time. And most, generally speaking, markets, the best decisions feel absolutely horrible to make. And the worst decisions feel fantastic because everyone's buying. You're thinking, oh, great, I can't lose, right? That's usually $73,000. When it feels dire and hellish and, it's really like everyone's telling you that you're crazy and the chart looks horrible and all that kind of thing. But then I look at this, I go, well, we're kind of trading at a level where if we expect this uptrend is an uptrend, if this is a robust and strong bull market, you'd kind of expect revisits and bounces from somewhere in and around the short-term holder cost basis, knowing full well that it may not bounce, it may keep going, right? Am I willing to just if that happens, do I just carry it on? Yeah, I just carry on, right? But I bought it 58K, not 73. That's really the way that I like to think about this, right? So yeah, we keep one bear market goggle on, but for me personally, at this point, it's like, well, if I'm going to take a chance, this feels like a chance that is worth stepping in and taking. Now the other thing is if we look at it from the percent supply and profit, right? We're down here at 33%. Now, this is something I found quite interesting. If we go back to our 2016 analog, we don't quite get down to that many levels often, but 35%, 36%, 36, 30, 32, these were all local minima, right? So we've actually recovered from these types of drawdowns regularly, actually, in spot-driven markets. Now, we didn't quite get those many pullbacks here in 2020 and 2021. Again, this was a bit of a weird bull market, lots of leverage, lots of weird stuff going on. Again, we could also continue just sinking lower and lower, and then it gets really dire. But again, let's put that in the box over there. Let's worry about that later on. That's a different post. We'll spend all day worrying about the bear market. But here we are in June. In June, we actually traded down to the local low. Actually, it wasn't even a 20% correction. And we had 25% of all short-term holders in profit, and we recovered. In fact, August was even worse. We pretty much had everyone. 3% of short-term supply was in profit, and we just rebounded, right? So we can recover, and it has recovered from these levels in uptrends on a regular basis. And more to the point, if we were going to set some kind of a low, it's probably going to be, think about this. Bull markets start at the worst point of a bear. That's, and bear markets start at the absolute most euphoric, best time of a bull. This is the great irony. And what I love about markets is you have to hold both positions at the same time, almost always. And I really find that as a good, when you just accept that it could go both ways, you look at things from both perspectives. You say, well, this could be the start of the most horrific bear that we ever see. It could also be a dip that's going to rip higher over the next 3 weeks. Both of these ideas are valid, and we have to just kind of assess it as it happens. And this is the joy of markets. I've found that when you free yourself from worrying about being correct and you more just allow the market to tell you what it wants to do and you kind of explore it day after day as a hodler, that makes my job a whole lot easier, right? Because I'm just looking for opportunities, knowing that my end objective is to stack as much Bitcoin as I possibly can over the course of the time that this world gives me, right? That's kind of the way that I think about these things. So again, sticking with a very, very similar theme here, right? We're talking about dipping below the short-term holder cost basis. Now, I often talk about undercuts in these metrics. Now, when I mean an undercut, one for most profit and loss metrics is break even. It's either like a perfect split between profit and loss. It's when people go from in profit to in loss. The level of one is usually a break even point. Now, again, let's keep 2016. When we get these nice little undercuts, right? Now, this is 0.96, which means that the average short-term holder is locking in a 4% loss on every coin that's spent. When we get these undercuts, they also tend to align with local minima. This is usually the point when the market decides, okay, thank you for selling the bottom. It's time for me to head higher now, right? And they can get nasty. Sometimes they can stick around for a bit longer. Also note that 2016, see how they're very sharp? This is it's a different market back then. Notice how our market is a bit more complex now. It's bigger, it's take longer to move, you get these deeper moves. So we do have to this is very textbook. We probably won't see this again. I'd love to see this again because I missed the 2016-17 run. I got in up here, not down here. But, you know, here we are getting a nice local low on short-term SOPR. Could it devolve into a bear market? Yes. Let's put that in the box over there. We've set all of our local minima when we get a pretty nasty down flush in SOPR. So not only do we have like our supply in profit has got to a level where you'd expect a bounce to happen. SOPR is there where you would expect a bounce to happen. We're trading below the short-term cost basis, which again is somewhere where if you're going to have a dip that's to be bought, that's where it would probably happen. There's a lot of mechanics here where it's like, yes, it could be the start of a bear market. It could be the most horrific thing we go through for the next 2 years. But if I believe that the bull market is still in effect, this is probably what a dip would look like. And it's probably what a dip would, in the rear view mirror, make Peter Schiff pretty upset about, right? So these are kind of the ways I think about it. And again, I'm not looking at it as it's not a premium. That's kind of the inverse here. I won't dwell on about this profit and loss ratio. Same thing, right? I mean, again, same thing. If you're going to get a dip, it's probably going to be at one of these undercuts. I won't spend too much time on that because this is the other one that I want to touch on, and I'm aware of time. Short-term holder MVRV, much the same story as we looked at with the Mayer multiple. We're now trading at negative 0.4 standard deviation. So we're now below the mean in terms of where MVRV tends to trade. Now, again, going back to that report we did the other week, we're going to look at the histogram in terms of bull and bear markets. Now, when I move to the next chart, there's 3 different traces. In orange, it's every observation of short-term MVRV. In green, it's going to be every bull market. Now, of course, it's easy to identify the bull market in hindsight and the bear market in hindsight. So what I've done, I've isolated those, and then we're going to accept that we don't know whether this is a bull or a bear. I mean, the fact that I'm moving my cursor up and to the right probably tells me it's probably a bull rather than a bear. But just keeping that in mind, we don't know what kind of market it's in. So let's compare where this cycle is in a bull market, a bear market, and on average, right? So we're looking at it from a statistical basis. How can we determine some probabilities? So let me turn off our bear case because I think that's less relevant. You'll see here that our bull market and our total average, green and orange, both of them are in a fairly similar area, right? This is our current value. Now, in a bull market, only 28% of observations are lower than where we currently are. Let me just turn off this one here so it's really clear. Only 28% of observations are lower. Now, unlike, you know, that's not, it could go lower, but most of them are higher. So if we believe that we're in a bull market, then there's a 70% or 72% actually chance that it wants to go the other direction. There's a 28% chance it wants to go lower, yes. If we look at it on the total market, 38%, so that's kind of telling us about 62% chance it wants to go higher. If we believe it's a bull market, then there is a higher probability that this metric wants to go to the upside. And that usually comes when the short-term holders go into more profit, which usually comes when the market goes higher, which usually, you know, yes, it could go lower, but it probabilistically, it's not overheated is really a big takeaway that I want to kind of leave you guys with. Now, if we look at it on the short-term holder, we're at 72%. Now, 72% is interesting because, you know, just for round numbers, that's basically saying that 30% of all observations are higher than that. So it would basically tell you that there's a pretty substantial amount of gravity to the downside, right? So let's actually just bring in our bear market model. And we can see that we're kind of on the, you know, it wants to pull us down to the low side, right? This is kind of where the gravity is. Most observations are more bearish than where we currently are, 72% of them. 30% is to the high side. So this is that dual concept that we need to keep in mind. But just, you know, if I really summarize all of this, if I just take the simple framework that it's more likely to be a bull market, and we have a number of metrics which, when they do what they're currently doing, historically speaking, it's been more opportunistic. That's really how I think about these things, right? As a hodler, that to me feels like something where it's like, I'll take a punt, right? And again, I'm not buying things to trade. To me personally, this is just something that this makes more sense than buying at 73,000 when everyone's telling me that it's going to 100K, right? Everyone's currently saying that we're going down to 40, right? I've seen people saying that we're going back to 30. To me, we're on the short-term holder cost basis, and we've historically found a floor somewhere in and around this level. So again, look, I'm going to be really honest. I have no idea which way this thing goes. This is just the way that I use my own data. This is why I built it, right? This is why Check on Chain came to be. I built a lot of these things because this is how I think about things. I look for probabilities, I look for opportunities, and really, I want to maximize my DCA. And I'm not going to maximize my DCA when the market's ripping to 73K, and everyone's telling me it's going up forever and there is no ceiling. When we're getting to something like this, there's a lot of cooling off that has happened, and it feels like a better scenario in that framework. So anyway, hopefully that's useful. Please let me know if you enjoyed this format, if you disagree, if you think it's, I'm always open to feedback, but it is a different style. Let me know if you enjoy this kind of content, because again, it's hard to know what people really want, but really exploring these different ideas and different ways to kind of convey it. But this is really coming at it from a bit more of a human perspective. And, this is just how I think about my own stuff. So anyway, hopefully that's useful. I'll catch you in the next one. Cheers.